Did you know that around the globe we use more than 100 million barrels of oil per day? With that quote lingering in your back head, I just want to say hello and welcome to the Saxo Market Call. My name is, as always, Søren Otto, and today I am joined by two great colleagues. And gentlemen, I would like to, before I introduce you, I would like to ask you this follow-up to that quote. What role does oil play in the global financial markets today, and are we underestimating the importance of them? Because I don't feel like we're talking that often about oil. We are, but not that often. Peter, let's start with you.
Well, I would say that the direct effect of the oil market is very low, simply because of the market value. So once upon a time, the energy sector, the oil and gas, was the biggest sector in the world and was a very major direct impact on financial markets. That's not the case any longer. But I think the indirect impacts via the economy and the price of energy and how it impacts our industry and our lives as consumer is still very big.
All right, Ole?
Yeah, basically agree with Peter. We take it for granted, and I think we quite often really forget how much of our dependence actually is on this black stuff coming out of the ground. Because I think when we talk crude oil, we talk about gasoline and diesel, and perhaps also jet fuel to when you go flying. But that's just a part of the story, and we can talk about that later if there's time. But from a financial perspective, oil is very much. Is still, from a trading perspective, very popular because it can be used as a directional play. It can also be used as a macroeconomic play because all the cost of energy does obviously impact everything we do. It has an impact on equities, on companies, whether you're a producer or a consumer of energy. So it does play a big part, which we sometimes probably don't really think about.
All right, and with that auditive introduction, I'd also like to formally introduce both of my guests today. We have the always great and always reoccurring in the podcast, Peter Garnry, our Chief Investment Strategist. And then we have you, Ole, one of our great guests, Head of Commodity Strategies. Glad to have you both here.
Thank you.
Thank you very much, Søren.
Great, and we have a great show lined up for you today. At least we think so ourselves. We're going to start, as always, with the current market status, performance, and any big news that we want to talk about from the last week, and also looking ahead for the coming week. After that, we're going to talk about this black stuff coming out of the ground, as you said, Ole. We're going to talk about oil, and we're also going to have a look at the commodity markets in general and see how they are performing at the moment. And then finally, we're going to end with a discussion here where we've kind of left earnings, and we're still waiting for the Fed to come out with the potential rate cuts. And we also have the U.S. election lingering in the background. I want to have a discussion between the two of you about what is actually driving markets today. But let's start with the first things first. And as always, we are kicking off things with a look at how the markets are performing. Peter, we have seen some significant moves in both sectors and regions, but what's the overview of what's been happening lately?
Yeah, if we look over the past week, we can see that the winning sector has been financials. So financials are really doing quite well right now. I think there's a little bit of an anticipation of lower interest rates in the short end of the yield curve. That means that banks will have to pay less for deposits, and if the long end of the yield curve can remain elevated and not go that much down, then over time that's actually could be quite a profitable thing for banks if we can have a positive shape on the yield curve. So that's one of the things. Industrials and healthcare have also been quite good. In the bottom, you find energy, and we can probably come back to why energy stocks are down. They're down 0.5% over the past week. Information technology and communication services, the two technology sectors in our universe, are also down for the week, and also the only two sectors that are down for the quarter. If you look at the information technology, down 0.6% for the third quarter, and communication services down 1.3%. If you look at the winners on a sector level for Q3, real estate and utilities are the two main ones. And why is that? I think the listener, if they know how the world works, these expectations of interest rate cuts coming. We have the 18 September meeting from the FOMC where they will likely cut 25 basis points unless we get a lot of awful U.S. labor market data in the coming days. They will go do 25 basis points, but the expectation is now for 9 rate cuts. So that's equivalent is 225 basis points or 2.25% from now until January 2026. And why are utilities and real estate responding to that? Well, real estate lives off interest rates. So, lower interest rates will be positive for real estate. I will say though that it is conditional a little bit that it's also the long end of the yield curve that will go down. If it's only the short term, you don't finance a lot of real estate with the short end of the yield curve, but it can ease some of the financial conditions and maybe just change the sentiment that we're at least not going to get higher interest rates. Maybe we just stabilize here in the long end and then the short end will go down. But real estate have done really well. And then utilities is because it is the sector that has the highest duration profile. And I'll probably have to explain a little bit what duration is.
Yes,
the duration profile means that duration is what we know from bonds. So it's basically your sensitivity to interest rate changes. And the longer there is to a maturity on a bond, the higher duration is, the more it responds to interest rates. That's also why you take more interest rate risk if you buy a long-term bond than a very short-term bond. I think intuitively a lot of people find that logic. And then logical, I should have said. And then utilities. So utilities is one of the most stable sectors we have. Very consistent and predictable cash flows long into the future because it's a highly regulated sector. And we can maybe come back a little bit to utilities because they're doing well because of AI and also doing extremely well because of low input costs from natural gas, especially in the US. But we can come back to that. So because they have these very long predictable cash flows, utilities, they have a very high duration. So they're very interest rate sensitive. And also, if you want to expand capacity, build new power plants, which is needed because of AI, it's a very good thing for your business if long-term interest rates could come down or interest rates in general are coming down. So that's why.
Definitely, and you mentioned AI that because it's so energy intense, AI just for people that didn't really make that connection. But Ole, how do you see the market digesting these developments from your point of view? Now we had the talk about both energy and utilities. What's your take on the latest performance?
Well, the commodity space right now is telling us that the world is in a bit of a predicament, a precarious place. We have some of the growth sensitive commodities struggling a bit, and a lot of that has got to do with China, where economic data continues to disappoint, where we know there's a massive overhang of properties unsold, but that's leading to lower demand for steel, for new construction. That's driving down iron ore prices. And then also keeping something like crude oil, as we talked about, in check. We basically right now seeing quite an interesting situation. There's a unrest in Libya between the eastern and eastern controlled part of the country and the government in Tripoli. That basically means that production from this country has dropped at this point in time, perhaps by as much as 1 million barrels a day. At the same time, the market is very focusing on OPEC. That's going to has announced an increased production for less than 200,000 barrels from next month. But even though we have this massive or big disruption right now, prices are actually not really moving. If anything, they're pretty near some very key and critical support levels, and that does indicate the market is from a macroeconomic perspective is not really seeing any major pickup in growth on the horizon, and that's keeping the prices weak at this point in time.
So I was just, when you talked to Ole said about that, I mean, it feels to me like we're getting closer and closer to the day when OPEC, the OPEC club, potentially will, fragment or dissolve itself, because it really is pegged on the idea that you have market power. And it seems like that is vanishing day by day with Guyana oil coming to the market. You have oil coming from the US. It's just not the same market as it was just 10 years ago, right?
No, and also as we approach peak oil, you mentioned $100, 100 million barrels a day. It's more accurate, probably around 103 million barrels being consumed this year, expected to rise to 104 next year. But then further out, it's going to slow down, and eventually we're going to see a negative growth in demand for crude oil, and that obviously will leave them challenged. And you are right, Peter, because right now we got Brent trading near close to $75. OPEC has been cutting production by more than 2 million barrels in the last couple of years. They desperately want to add those barrels back in to raise the revenues, but it potentially comes with a lower price tag. So yes, the market share question is one that will continue to play its part, especially considering some of the major producers in the Middle East. They have massive amount of spare capacity they want to increase, and especially if the demand for their oil is starting to taper off in the next 10 years.
Yeah, and I think we are moving into oil afterwards. So just before we go further into that, Peter, what's the upcoming events the coming week that the investors out there should pay attention to?
Well, I hinted a little bit to it already. So in the coming days, it's Tuesday today. But in Wednesday we have the JOLTS job openings. On Thursday we have ADP employment change in the US, and then on Friday we have the non-farm. So we know from FOMC voters and the Fed speakers that the focus has shifted quite a bit from inflation to the labor market dynamics. So keep in mind that the Fed has a dual mandate: price stability through an inflation control, and then they have a mandate for employment. And they're shifting their focus to employment. And I wrote a small comment, which you can find on our trading platform yesterday, where I showed, labor market tightness. That is something you can derive from the JOLTS job openings. But you also have a weekly time series from Indeed, which is this job posting portal or a platform. It's in many countries, but they have these weekly series where you can actually get an idea of what is the seasonal adjusted job posting in aggregate terms in the US. And you can see that the job postings market in the US have come down significantly over the past 18 months, but seems to be stabilizing a little bit. So I think these indicators are going to be super crucial because the FOMC rate decision is coming up in 2 weeks from now. So the labor market data are going to be super important. There will be an inflation data point coming as well. But otherwise, it's a very quiet period we're in right now in the market. We have Broadcom earnings on Thursday. So in the land of equities, it's very quiet outside the idiosyncratic stories that are coming here and there. We had Volkswagen yesterday talking about closing a car factory in Germany for the first time in its 87-year-old history, which is a pretty fascinating story in itself. But otherwise, quite quiet. And I think Broadcom deserves a little bit of a comment here. So I don't think a lot of our listeners would know that Broadcom is actually the 10th largest company in the US. It's a massive company. And they do what's called ASIC chips, and it's very special purpose-built chips. So it could be a chip that you put into your Apple phone, which can render video better and faster. It could be chips for whatever radio communication. It could be, they also do bespoke or purpose-built chips for AI applications. They do a lot of things. It's a huge business, and they're doing very well. So the listeners might be wondering, okay, so they're doing AI chips. I thought it was only NVIDIA, but it's because NVIDIA's GPUs, as they call the Hopper chips, and soon to be released the Blackwell chips, are what is called general purpose. So they can really be used for many different things in the AI application world. Whereas the Broadcom chips are much more purpose-built. So apparently there is room for both, and it's a very high quality company. So people can watch that on Thursday. They will be reporting after the close.
So just out of curiosity, Peter, we had NVIDIA reporting last week, and that seemed to be probably maybe the most important earning this year altogether, not just for NVIDIA but also for AI and the markets in general. I assume that Broadcom won't have the same ability to move the entire market as NVIDIA had.
No. Broadcom is one of those stocks that have had zero interest, I think, from retail investors. You never hear Broadcom being talked about. So this has been this silent outperforming stock for 2 decades. It's just gone from nothing to being the 10 largest stock. I mean, a phenomenal ride and phenomenal business, and interesting that you can have these stocks and these companies, rise to, become what Broadcom have become, and without any notice by a lot of people. Surely it's known by institutional investors, but I don't think retail, they know a lot about Broadcom. Also because they just live a life as a potentially boring supplier to successful companies like Apple. It's one of Apple's biggest suppliers.
All right. So a lot of financial data coming out, and also this one earnings release. So now I'll let the reins off a little bit and let you guys back into the oil discussion that we just quickly started before. It's so wonderful to hear you guys how passionate you are when you start talking about a topic like that. And Ole, I want to start with you because when I prepared for this episode and figure out what I should say as the first interesting topic about or comment about oil, one of the other things that came to mind was this idea that we actually had during COVID, we had negative prices, which is pretty far off from where we are now, where we're in the 70s, as you say, in the prices. And it also seems one of the things you've mentioned quite a bit is that the price is kind of range bound right now. It can only move slightly up and down. Could you? I know you touched upon a little bit of it, but could you try and lay out what is the driving force behind this stagnation we're in oil right now?
That's several things, but you mentioned negative prices, and I think that what negative prices back in 2020 highlights is just that commodities market is a fine-tuned engine where you have supply and you have demand, and if you, for some strange reason or for some occurrence through a short or longer period, have a massive mismatch between the two, then the price responds very, very aggressively, and that's what we saw in crude oil back then, where global oil demand suddenly fell off a cliff and production was still coming out of the ground, and where we're going to put it if you're running out of storage space, you basically have to almost get rid of it or pay
burn
someone,
it.
burn it, or pay someone to take it off your hands.
And you remember these ships outside of ports that just couldn't come in and deliver the oil.
Absolutely. And again, right now, for instance, in natural gas, we got 55 ships. That's been LNG ships that have been stuck in sea for more than 20 days. That's kind of an indicator. That's more than 4 million tons of LNG that's sitting out there. That's the highest level in 2 months. That's basically another reason why natural gas right now in Europe is coming down a little bit, because there is actually supply out there looking for a buyer. So it's a fine-tuned machine. The crude oil market, the energy market, it is ultimately all about growth and demand around the world, especially the heavy energy consuming nations, China, US, India, and as we've all been watching in the last year, we've seen a slowdown in China, and we're also seeing the big rollout of EVs, which is now accounting for more than 50%, I believe, of new car sales in China. So they're really one step ahead of the rest of the world in that transition, and that basically means Chinese energy consumption will probably peak this year, especially gasoline and diesel, and that's adding that's been adding a bit of stress in the market, because that's really been the growth engine for increased production in recent years. Other countries will probably pick up some of that slack in the coming years. India is obviously the one to look at. There they have much better economics right now. So that point it looks like a positive story emerging for demand. But overall, we are stuck in a range. We've been range bound for almost 2 years now. The range is getting narrower and narrower. If you look at the charts, we got lower highs, we got higher lows, and we will see a break eventually. And right now, obviously, we're very close to the key level, which I would say in Brent crude is around $75 a barrel. If you do break that, I think that could trigger some momentum selling, and then we'll have to see what OPEC wants to do next, because their ability to control prices seems to be fading somewhat. We've had multiple geopolitical events in the past year, and none of them had any long-lasting impact on prices. Simply because, as well, the supplies coming out of the Middle East is coming out from areas which are not impacted by the current unrest, and the risk of it spreading to those areas is very, very limited at this point. So demand is a key, and then obviously supply is key as well. OPEC is keeping supply down. Other non-OPEC producers are actually increasing production. Peter mentioned Ghana, which is becoming quite a big player in within a very short period of time. That could be the next Norway, simply because they are setting up structures to have an oil fund, to basically learn from other countries' mistake and generate the save up for future generations. So it seems like there's a good case going on there, and then ultimately, we'll have to see how speculators and investors they respond to these. I think overall the market is still having a structure which is pointing towards somewhat of a tightness in the market. So spot prices are higher than future prices. That basically means even if in a year's time prices have not moved, you will still make money on an ETF investment, because of what they call backwardation. So you have to keep that in mind as well.
And I think we still owe listeners to talk about backwardation and contango in further detail. Let's schedule that for some time close to here. But I want to pick up where you left off in this OPEC discussion, because it's clear that obviously if new markets come in and can decide to turn up or turn down their oil production, then OPEC, which is this group of oil market producers, specific countries, then their market ability, or their ability to decide the prices will of course be limited. So what's the future of oil? Like what is it that will break out this narrow tightness we're in?
Well, we have to remember that OPEC's current problem is also caused by their own actions, because they've taken production out of the market. They kept the price artificially high, perhaps higher than what the economic outlook was actually justifying. That has invited non-OPEC producers to increase production because of the high prices they could sell at. So really, right now, if we continue to see this mismatch, then it's the old saying that the best cure for a high price or a low price is a low price, because the low price will basically kill some of the production and eventually stabilize the market. So the question is really whether OPEC at some point are willing to let the prices drop to the level where it kills production. They tried it before and they failed quite miserably in that exercise. So I think they will fight tooth and nail to maintain prices at these levels, and that's also my base case for not really expecting we're going to see a major drop, let's say below $70 at this time.
All right, and just to follow up on, you mentioned this idea that China is its consumption of oil and diesel and gasoline will probably top this year because, among other things, the introduction of electrical vehicles. That will, of course, require electricity. So I'm just curious, something like copper, for instance, which is used to build up electricity grids, is that reflected in that price? Have copper then performed better relatively?
Not in the past few months, and this just highlights another aspect of commodities that, as I said, it's supply and demand driven. And even though you have expectations for demand outstripping supply in the coming years, it doesn't really help if we at this point in time have a surplus, which we do have, and that's why price has been under pressure. So it's just a lesson. We've seen that in other markets like uranium, where there's a very, very big bullish case for or at least by many investors and traders, that uranium will be a growth story in coming years. But right now, the supply and demand situation just simply doesn't justify higher prices. That's why we had this big rally at the start of the year, both in uranium and in copper. Since then, they come down quite rapidly. I still believe that the long-term outlook for copper is very strong. We can see the big mining companies, they're cannibalizing each other. They're trying to buy copper assets, instead of because they know it's punitively expensive to go out and find and dig for new copper finds. So they'll much rather pay a premium for a competitor to get the assets, and that's obviously that they wouldn't do that if they didn't have a firm belief that demand will be strong in the coming years.
All right, so we've talked about quite a few commodities now. Obviously, if you just look at the news highlights, it seems like oil is the one that's stealing the picture there most of the time. Are there any other commodities you feel like we should mention before we move into our third part of this podcast?
Yeah, we have to talk about gold, because it is the biggest investment right now across the commodity space. We're seeing that. And we've seen this almost counter-cyclical rally now in the last couple of years, where rates has been going up, gold has been going up as well. It seems like we're having a bit of a pause here. We hit another fresh record high last month. Since then, we stabilized. There is a bit of a seasonality kicking in here. September, historically, in the last 10 years, we've only seen gold actually rise in one of those Septembers. Seasonally, we've seen equity markets struggle a bit in September. We've seen the dollar actually showing a bit of teeth in September, and that has basically led to negative returns in gold for the last 7 Septembers. And this year, as we're heading towards the FOMC meeting, the question is really how much has been cooked into the price already. I would probably say all of it, and that basically leaves the market a little bit exposed in the short term. But I think that's also quite a healthy sign, because gold has really gone gone a bit stale here. I think we need to see a correction just to let some fresh air into the market and let some investors catch up who may want to be involved but feel that they can't pay record high prices. So I think just a little bit of caution here in gold in the coming weeks. But underlying, the reason for why gold has rallied, they have not gone away, and they're probably even going to strengthen. So still see gold higher.
I mean, I gotta follow up and open the floor to both of you. Seasonality in September, seasonality in gold and in equity markets. Do we have any way to explain that? Because I mean, I don't really see any particular reason for why that's the case when we talk about weather, for instance, which is one of the things you often refer to as a seasonal thing.
Well, September is the month where everyone is back behind their screens. July, August, 2 big summer months for vacation. Maybe that plays its part. But why stocks has why we've seen these is a little bit difficult to gauge. I know that the gold market is previously has already relied a lot on Indian demand into their festival seasons. That really kicks off in October. That's why the last 3 months tends to be quite good. And we know that the economic outlook in China or in India looks really well quite now. That basically means the middle class has got more money in their pockets, and some of that will go to investments and savings. And part of that savings, even though equities become more popular for a broader audience in India in recent years, gold will still play its part there. So I see a pickup from that part of the world into the final quarter.
Pete, do you have any?
Well,
big insights?
I think seasonality patterns play a bigger role in commodities than they do in equities. I know there's a lot of sort of attempts by media outlets to talk about September as being the worst month in equity markets over the past 5 years, and statistics. There's a lot of randomness in market, and you don't have any statistical significant seasonality patterns in equities, because if it was just that easy, you could make money from it, and because that would be very easy. And if you do that, you basically arbitrage away the seasonality effect in equities. But in commodities, which is anchored in the physical world, there are some constraints because of the way the planet spins, and the northern hemisphere, the southern hemisphere, the seasons. There's a natural cycle there that you cannot really escape because it's physical laws. But when it comes to equities, it's not something I would pay a lot of attention to.
Time flies when you're having fun, and let's now move into the final part of the episode. Maybe a slightly shorter discussion, because I think we've been around a lot of the things, but we are in a situation right now, seasonality aside, where we have just left the earnings season, at least the bigger part of it. Obviously, we have Broadcom, as you mentioned, Peter, this week. We are waiting on the Fed to announce most likely rate cuts, and then obviously we have a U.S. election lingering out in the near and nearer distance. So I think it was very interesting to have you two guys discuss what is driving markets right now, because commodities is a place where things are always happening. We also have this increased focus on job, like the job market, especially in the US. So what's your take, Peter? I'll start with you. What's your take on what is the main driver of the market right now?
Well, the main driver of the market is always the probability of recession, because it's the recession that changes everything. The supply and demand equations for commodities, it's what changes the near-term outlook and thereby market value for equities. And that is linked back into the market's idea about where interest rates go from here. So I would say the predominant questions that are being asked are around recessions and the trajectory for policy rates in the US and Europe. And we all know that the rate cutting cycle will begin. So the question is the speed and what is sort of the floor, if you will. The market right now, as I said, nine cuts, so 225 basis points until January 2026. At that point, we will hit the neutral rate, estimated by the Fed at around 3%. So that's sort of the consensus trade that is being priced in markets. The US election will play its role, but it's a little bit more on the nuances and a little bit more on the margin. Right now, it's all about whether because if you look at interest rate policy rate cutting cycles, historically, it marks the beginning of sort of the end of a bull market. And in most cases, when you look far out, commodities, equities would have not been doing quite well, and also risky currencies would not have been doing quite well if you extend your time horizon enough. But bonds will do quite well. This time, it's a little bit different because the rate cycle that starts will not start because of a weak economy and we are slipping into a recession right now. It starts because there is now room to lower the policy rate because inflation, maybe not 100% under control, but at least enough under control that we can begin easing the financial conditions in the short end of the bond market, the yield curve. So that is what is taking place, and there's a couple of different scenarios. So one scenario that the market is really looking at is the one that is consensus priced in right now. The Fed will be able to lower the interest rates by 200 basis points. There is enough momentum in the private sector on investments. AI plays a role on that. Semiconductors in general. There is enough fiscal impulse generally. It's probably a little bit going down, so a little bit less impulse on the US side, maybe a little bit more impulse coming in Europe because of defense spending. At the margin, what will that mean? Can we engineer a soft landing? The Fed has never really been able to do that in the past. So, but there's always a first for everything, right? So I think at this point, there's just a lot of uncertainty. One of the things on where the US election plays a role in all of this is if we get a Harris win with a gridlock situation in the Congress, where the Democrats don't control both houses, because in that scenario the Republicans will block a lot of things, and there could be a lot of fiscal impulse that cannot be extended. There will be a lot of fiscal measures that will be potentially even ended, and that could increase the probability for a recession in 2025, I should say. So right now, all of these things we just discussed, or I said, it's not a discussion, but what I said is what's driving the market, is what drives gold right now. The recession probability and China is what's driving oil. What we saw in equities, as I said, over the past week, the interest rate sensitive parts, utilities, financials are doing great. Real estate are doing great. Growth, on the other hand, with the technologies, are not doing as well. So you're seeing the impact of that consensus trade and all the opinions of people, and so I think that in the very short term, over the next 6 months, I think you're okay by being overweight in risky assets, but we are potentially approaching a key inflection point. As I said, the Fed has never really managed a soft landing before, so why should they do it this time? But who knows what the future looks like.
Ole?
Well, the beginning of the rate cut cycle historically has been positive for investment metals. Again, talking about gold and probably also with that silver and some of the others. But at the same time, industry will some of the capital intensive industries will see their cost of funding come down. The mining industry is one I would be watching, because if we start to see lower interest rates, and with that we see higher metal prices, then if mining companies at the same time can drive down their cost of capital, then that potentially could see some of these companies start to outperform relatively to what they mine. So I'll be watching that closely. But as Peter said, commodities are ultimately growth dependent and leading to demand. So the recession is still the big question, whether we can steer away from that. And at least for now, as Peter's mentioned, it looks like we can, even though there are some soft spots.
All right. Obviously, it's a tough thing to ask you guys to discuss when you are actually in agreement on the outlook. So I still hope that that was an interesting talk about what is driving the market currently. I think that will wrap up today's episode. Peter, Ole, do you have any final thoughts before we say goodbye?
No, not really. Look at the labor market data this week, and if you want some to see some new things in equities, and maybe look at that Broadcom. I think it's an interesting company.
Ole, anything?
Well, no, because I agree with Peter. labor market data, because of the reduced focus on inflation.
Okay, so apart from all the financial talk, we can also conclude that we generally agree here in Saxo. But thank you both, Peter and Ole, so much for sharing your valuable expertise.
Thank you very much.
And thank you to all our listeners out there for joining us today. We always appreciate your feedback, so feel free to reach out at Saxo Market Call at saxobank.com. Don't forget to tune in next week as we continue to navigate the complexities of the market. But until that, stay informed and invest wisely.